All right. Good morning, everybody. Can everybody hear me okay? Awesome. Robert, did you choose that song? No? I wonder who chose that one.
Good pick. I did not choose it, though.
I know. I love Dave Matthews Band. I saw them like 10 years ago, and it was still at Red Rocks in Colorado, and it was still one of the best concerts I've ever been to. So
I saw them 23 years ago, I think.
Okay. Yeah. Well, they're timeless. They're a timeless band. All right. Well, everybody, welcome to our group session number 3. Today is going to be surrounded around all things funding. So I think these are the questions that us as coaches that we get the most. I think a lot of people have questions around funding and financing their business, as you should. So hopefully we'll get some of your questions answered today. I just wanted to mention my background is for Lunar New Year. So if any of you are familiar with the year 2026 for Chinese New Year, it's actually the year of the fire horse. Yes, the fire horse. So really what this year is supposed to symbolize is this immense transformation, right? Going after the things that you really want to this year. Last year was kind of shedding of the snake skin, and this year you're jumping into it and into independence and freedom. So maybe let that be, symbolic for you and jumping into business this year. All right, so what we're going to be going over today for our agenda, big picture as always, zooming out, seeing where we've been, where we are currently, and then where we're going. We're going to look over our leaderboard and see where everyone is stacked up in the class. And then I'm going to hand it over at that point to Michael Reeder, who is going to start talking over financing options, entity selection and formation. He'll talk tax strategy, unit economics, so all the good stuff. So make sure to have your note takers out to get in all that information. And then at that point, Sarah's going to take over and she's going to discuss some of outsourcing and how important that is to outsource some of those things, right? Where as business owners, we are spread thin. So I think it's very important that we understand that we don't have to be the experts at everything and to outsource some of those things like funding and financing and things like that to people like Michael, CPAs, the experts. And then we'll go over our Q&A. And then finally, as always, just end with our breakout sessions with the coaches. All right. Okay, so we are currently in week 6. We're halfway up the mountain. We're in that funding stage. We started, believe it or not, a little over a month ago doing the info session where you guys were just learning about this opportunity and you all applied, got into the academy, and we kicked it off at the end of January. Since then, you've had your discovery calls with your coaches. You have been presented franchise options and then chose maybe 1 or 2 of those brands and started speaking with them and doing those franchise or calls. That's where most of you are at this point. And some of you have even received, that FDD, the franchise disclosure document from the franchisors. Some of you have even started validating with other owners within the system. So as you can see, once we kind of handed you over to the franchisor, things picked up pretty quickly. And just to understanding that, this stuff can be very overwhelming, but just also understanding that your fears at this point might be kind of creeping in. So you still have, the support of us as coaches. And now we're starting to introduce these amazing resources like Michael Reeder and some of those legal resources too, which will be next week. So you guys have that support system behind you. So yeah, next up is going to be FDD and validation group session call. That'll be next week. And then we'll go over Discovery Day, what that's going to look like as you guys start getting invited to those. That can also be called Confirmation Day or Meet the Team Day, really where you're just meeting that corporate team. And then finally, graduation, April 9th. All right. So here's where everyone is at. We've got one still doing presentation of options. Jonathan is starting his franchisor calls here shortly. And then the majority of you are sitting in funding and FDD review. So right where you guys should be. You guys are looking
And Robert just went into validation today.
Oh, amazing. That's great.
Yeah.
Yes. I think like Eric too, you're doing validation right now as well. So yeah, and some of these things you will notice they happen simultaneously, right? So you might receive the FDD and you might get some of those contacts to start doing validation. So you guys are looking really good. Continue to show up to those calls prepared and continue to communicate with your coaches. Okay. All right, so now I'm going to hand it over to Michael Reeder. He is with the Reeder CPA Group, and we're really excited to have you here today, Michael. Thank you.
Thank you, Brittany. It's great to be with you all today. As Brittany mentioned, my name is Michael Reeder. I'm a CPA, and I'm the owner of Reeder CPA Group. We're a full-service accounting and tax practice. We're a virtual national firm. We have locations in Illinois and Maine. But we have clients all across the country, and we have team members all across the country. We work with franchise businesses all across the country, and we work a lot with a lot of veterans as well, and it's such an honor. And so my niche as a CPA is working with business buyers, working with franchise buyers. I own the CPA firm that hired me out of college. I've been doing the CPA thing for about 15 plus years, and over the last 11 plus years, I've developed a nationwide network of franchise professionals, such as Vetrepreneur, to be a CPA resource for their franchise buying candidates, such as all of you, to dive into the topics of entity structure strategy and funding strategy from the angle of strategic tax planning, as well as just overall general tax questions that you may have, being self-employed, being a business owner, being a franchisee. And so I've built out this process of the free Reeder CPA Group consultation for entity structure and funding from the lens of strategic tax planning. And we do webinars, we do one-to-ones, and so I've been having these types of conversations with franchise buyers for the last 11 plus years. In my industry, there's, right now it's tax season, so it's a busy season, right? But in my industry, there's peaks and valleys in terms of busy season and non-busy season. But what we're doing at Reeder CPA Group 12 months out of the year is having these types of conversations with franchise buyers, right? Diving into entity structure and funding strategy from the lens of strategic tax planning. So you'll see on the slide, financing your franchise, there's 6 options there, right? There's SBA loan, HELOC, right? That's an acronym for home equity line of credit. Then there's a 401k or TSP loan, and then ROBS, that's an acronym for rollover as business startup. And then there's cash, and then there's family or friends loan or equity. I would say there's also there's also what's known as a margin loan, often referred to as, it's also referred to as a securities-backed line of credit. But if you have a non-retirement stock portfolio, you may be able to get a line of credit against it. Usually, depending on the size of the portfolio and where it's sitting, you may be able to get a line of credit against it for 30 to 50% of portfolio value. So keep that in mind as well. But when it comes to, when it comes to, well, which is the right one for you, right? Like out of these options here, or a combination of them, what's the best combination for Robert? What's the best one for Jonathan? For GT, et cetera, et cetera. It all comes so in order to properly advise you on entity structure and funding, we first need to get context on what I like to refer to as your 3 buckets, right? So bucket number 1, what's your initial investment? Initial plus the first 12 months, right? All in, franchise fee, working capital, build out if applicable, right? So what's your investment? And then bucket number 2, what's the allocation of assets on your personal financial statement, right? We're looking for cash, other liquidity, retirement, and real estate. And then bucket number 3 is what's your household income and expense situation looking like, right? Income, do you have VA disability? Do you have military pension? Are you still active duty? Do you have any other corporate W-2? Does your, do you have a spouse? If yes, does he or she work? Do you have rental income? Do you have, interest, dividend, capital gain income? Do you have another business bringing it in? It's like, what's your income situation in your household, right? So investment, assets, income. Like once we have those three things on a piece of paper, then we can advise you optimally on how you should go about structuring your entity and funding your business from the angle of strategic tax planning. And so let's go to the next slide. I don't know if it's Edgar or Sherry or thank you. So let's see, choosing the right entity and formation. So so it really comes down, there's really two different, like I would say that let's talk about it's really LLC and C corporation, and let's dive into that, right? So an LLC is a legal structure at the Secretary of State level. And an LLC is a hybrid entity when it comes to taxes. So an LLC with one owner by default is going to be taxed as a sole proprietor. An LLC with two or more owners is going to be taxed as a partnership. And an LLC at any time, either at the beginning or subsequently, can elect to be taxed as an S corporation. An LLC can also elect to be taxed as a C corporation, but you don't see that often. I won't rabbit hole into the reasons why. For the most part, an LLC is going to be taxed either as a sole proprietorship, a partnership, or an S corporation. And what do those three tax classifications have in common? They are all what are known as flow-through entities. So the bottom line, so if your LLC is taxed as a sole proprietorship or an S corp or a partnership, the bottom line, the profit or loss from that entity is going to flow through to and get reported on the personal tax return of the owner or the owners, plural. And what's cool about an LLC is that you can start out by being taxed as the default and the default tax classification, right? So a single member LLC, default sole proprietorship, multi-member LLC, default partnership. And then in year 2, 3, 4, like whenever the profits of the business justify it, you can take that same LLC and elect for it to be taxed as an S corporation. And you do that in order to save money in Social Security and Medicare taxes. So the primary tax saving benefit of having your LLC taxed as an S corporation is to save money in Social Security and Medicare taxes. You're going to see C corp most often going down the path that you're going down right now, preparing to invest in a franchise. You're going to see C corp when you're if you're going to go the ROBS route. So in the prior slide, one of the funding options was ROBS, right? And ROBS is an acronym for rollover as business startup. So ROBS is a funding structure, and so funding and entity structure and ROBS are attached at the hip, because if you do ROBS, you have to be a C corporation. And the reason why is because so ROBS is the most common retirement asset funding strategy. And so how a ROBS works is you set up a C corporation, and then you set up a retirement plan for the C corporation. And Vetrepreneur works with great ROBS companies, whether it's Fran Fund, Benetrends, they're all great. You work with the ROBS company to set up the C corporation, and then the ROBS company sets up a retirement plan for the C corporation. And then the retirement plan is going to invest in the stock of the C corporation. So because the shareholder of the C corp stock is a retirement plan, it has to be, the entity has to be a C corporation. So you can't do ROBS as an LLC or an S corporation because it's mandated by law that if the shareholder is a retirement plan, then it has to be a C corporation. So that's why if you do ROBS, you have to be a C corporation. And so how it works is you set up your C corp, and then you set up the retirement plan for the C corp, and then step one of the money flow in ROBS is the rollover. So if you have existing, TSP or IRA pre-tax retirement money that's eligible for rollover, you're going to roll that money over into the new ROBS C corp retirement plan. So that's step one of the money flow in ROBS, the rollover, the tax and penalty free rollover. And then once it's in the C corp's retirement plan, the retirement plan is going to invest in the stock of the C corp, and then so it's going to go from the C corp retirement plan to the C corp checking account, where you can use it for the investment and operations of the business. And that's step two of the money flow. That's what's known as the capitalization of the business, because the retirement plan is purchasing the stock of the C corporation. And so in a C corp, so a C corp is not a flow-through entity. So the bottom line in a C corp is not going to flow through to and get reported on the personal tax return of the owners like a flow through, like an LLC tax as sole proprietorship, partnership, or S corp would. A C corp is going to stay in the C corp, right? And so, it's expected that if you're starting a business up from scratch, it's expected that, when you're ramping up from zero, that you're going to have a startup loss. That's completely normal. And so that loss in the C corp is going to stay in the C corp, and it's going to, it's not going to flow through to the personal return. It's going to stay in the C corp, and it's going to roll forward as a net operating loss carry forward to offset subsequent year C corp taxable income. And beyond reimbursing yourself for business expenses paid from personal funds, when you want to take money out of a Rob C corp for personal use, you have to take it out as salary, right? And so you have to, with a Robs, you have to, so because either the entire, like the 100% shareholder or at least one of the shareholders in a Rob structure is a retirement plan, then the Robs is subject to ERISA compliance. ERISA is legislation that governs employer retirement plans. And so because Robs is subject to ERISA compliance, when you're in a Rob structure, you have to be aware of prohibited transactions. And this is why it's important to work with a CPA firm that understands Robs, because it's, first of all, it's amazing how many accounting firms out there don't even know what Robs is, and then a lot of firms out there have limited understanding of it. My firm and a handful of other firms, do have a solid understanding of Robs, and there's probably more, but it's my firm and a handful of others are CPA firms that are well versed in Robs, and so you want to make sure that you work with a firm that's well versed in Robs. Because if they're not, then they may just see a C corp as a normal non-Rob C corp, and have you, for example, 1099 your side consulting S corp, and that's a no-no in Robs. But if it was just a non-Rob C corp, that's no problem, as long as it's arm's length, or doing you want to take a shareholder loan and it's arm's length with a promissory note in a non-Rob C corp, that's no problem. But that's a no-no in a Rob C corp because of related party. It's considered a prohibited transaction. So that's my little spiel on Robs. And so for the most part, just to bring entity structure in, you're gonna mainly see LLC or C corp, and if it's LLC, it's going to be taxed as one of those three flow throughs. And if you're going C corp, it's most likely because you're going the Robs route. And so there's certain tactical things about going Robs, that we can dive into on our one-to-ones, or if you join a reader webinar. I'm actually going to be doing a reader webinar later this afternoon, but we're running them multiple times each week, and the Vetrepreneur team can give you access to them. And so regardless of what route you go, and those are all free, by the way, whatever route you go with setting up your entity, you start with the Secretary of State. So the Secretary of State, you file an Articles of Incorporation if it's going to be a C corp, or you file an Articles of Organization if it's an LLC, right? And if it's a Rob C corp, that's part of the service that the Robs company does for you. And if it's an LLC, you can work with my firm, you can work with your local firm or your local attorney or a LegalZoom. So you get the articles at the Secretary of State level, step one. And then once you have the articles, you get the tax ID letter from the IRS, step two. And then you register at step three, you register your entity with any and all applicable state and local taxing agencies for payroll taxes, sales taxes, withholding tax, etc. So let's go to the next slide, please. Alrighty. So key deductions for franchisees. So startup costs, franchise fees, marketing expense. Alrighty. So it's important to understand terminology. So when you invest in a franchise, what you invest up front, like one of the things that you're going to pay initially up front is the franchise fee. And the franchise fee is, you can't expense it all. And like you can expense marketing and royalty and insurance and labor and supplies. All of those expenses are expensed as incurred. But the initial franchise fee is what's known as an intangible asset. And so for income tax purposes, you have to capitalize it as an asset and amortize it over 15 years. So that's how an initial franchise fee is treated for income tax purposes. Even if the life of your territory is 7 or 10 years, for income tax purposes, you have to amortize the initial franchise fee over 15 years. And then it's important to understand the terminology difference. So what I just mentioned there is a franchise fee. A royalty is the monthly fee that you pay the franchisor, which is a percentage of revenue, and that's expensed as incurred. So royalty, monthly, expense as incurred. Franchise fee, you pay initially, and it's capitalized as an asset and amortized straight line method over 15 years. Tax strategies for veterans. So yeah, so something that there's no downside to research when you're going through, you know, the journey that you're on right now. There's no downside to research what's available to you in the context of municipal, county, state, federal, nonprofit loans and grants, right? There may be various micro loans and grants available to you. You know, maybe if you're in this county, in this state, or this municipality, whatever it is, there might be, you know, a $5,000 or $10,000, maybe less, maybe more, you know, loan or grant available to you for being a, you know, certified disabled veteran-owned business, right? And also if you're a certified women-owned business and or minority-owned business, you know, there's no downside to research that stuff because if it's there, it's low-hanging fruit, you know, take advantage of it. And then, you know, depending on what industry your franchise is in, you know, you may qualify to get contracts, you know, if you're a certified, you know, veteran and or women and or minority owned business. So those are always things to look into because there's no downside to, you know, the worst that can happen is the answer is no, right? And you just move on. But proactive, so for example, at our firm, you know, we want to make sure that we're doing more than just filing taxes. We want to make sure that we have touch points with our clients throughout the year to talk about strategy and implement strategy. So, you know, just making, you know, you want whether you work with my firm or your local firm or some other firm, you want to make sure that you have a CPA relationship, that you have a normal dialogue throughout the year, as opposed to just the normal January through April grind of filing last year's taxes, and then you don't talk to your CPA until next tax season, right? You want to have at least a couple touch points throughout the year, talking strategy and implementing strategy, because doing so can save you thousands of dollars in the here and now, you know, both short term and long term. And so just, you know, making sure that you reframe, if you haven't already, reframe, you know, what does a normal relationship with the CPA firm look like? It's a year-round dialogue, it doesn't have to be every month, right? It doesn't even have to be quarterly. And is it just taxes, or are you working with your CPA firm for bookkeeping, payroll, sales tax as well? But, you know, just make sure that you have a normal, you know, consistent dialogue with your tax professional throughout the year, as opposed to just January through April. You know, I mean, this third one is so important. Maintain accurate financial records. Bookkeeping is so important, and it's amazing how many small business owners just don't take it seriously. And so you want to get your bookkeeping, whether you're going to DIY it or you're going to work with your CPA firm, or maybe the franchisor will require, you know, some franchisors will require you to use their, you know, preferred bookkeeping vendor for, you know, for either the first year or in perpetuity. But whatever your bookkeeping solution is, you want to make sure that you have a bookkeeping system in place from day one, and you want to keep it updated, because as a business owner, you need to know your numbers. If you don't know your numbers, you're always just operating based off of what's in your bank account. But if you have accurate, updated books, it streamlines the tax return preparation process. It also allows you to have a substantive tax planning conversation. It allows you to have a substantive CFO centric conversation to talk about cash flow and profitability. It also, if you ever need to submit financials to a third party, if you're trying to get a business loan or you're trying to get a mortgage on your house, you know, and you're self-employed, they're going to want to see tax returns, but they're also going to want to see financial statements, including interim financial statements. And so if your books are updated and accurate, it's just click a few buttons and send it. You don't want to make it this 2 to 3 to 4 week, you know, pulling teeth trying to get it right, and that never looks good in the eyes of the lender. And then same thing, you know, I'm kind of jumping the gun here, but you know, because right now you're getting ready to buy the business, to invest in the business. But if you know, if your plan is to build the business and have an exit in the next 5 to 7 to 10 years, when you're exiting, any interested buyer is going to want to see financials. And if your financials are updated and accurate, then it's just an easy document request, and that looks really good in the eyes of the buyer. And then every day that that goes by between the day that they request it and the day that you give it to them. Days, weeks, months go by, and you can't, momentum on the deal is just, decreasing the longer that it takes for the, buyer to obtain information that should be pretty straightforward. So all of these are reasons why, if you have accurate books, all of those things are streamlined, and everything that I just mentioned is a non-issue. And then if you don't have accurate books, if you don't have any books, or they're messy, or whatever the case is, then it creates friction in all of those things that I just mentioned. Stay compliant with payroll and employment taxes. I'm sure that you've all heard of companies such as ADP, Paychex, Gusto, Paylocity. These are all, they're all, you could work with QuickBooks for payroll. I tend to not be a fan of QuickBooks for payroll, just because there's things that you have to do manually, and you can do it, and some people are more, like have a background doing this stuff, and it's no big deal, but some people don't. And so I like the companies that I just mentioned, just because, you're like, every time you click submit, they're going to take the taxes out. They're going to electronically file all the reports, federal and state, so you don't have to worry about payroll and employment taxes. You can just focus on, scaling your business. And then every state is different when it comes to sales tax, income tax. All states are different. So just making sure that you understand, what are your state and local tax obligations, not just income tax, but sales tax and payroll tax, right? If it's payroll tax, the payroll provider will take advantage of it. We'll take care of it. It's really the sales tax is the thing that could be the most tricky, state by state, because all states are different when it comes to sales tax requirements. All righty, let's go to the next slide. So importance of P&L statements. I won't beat a dead horse here. The important, like everything that I just said about the importance of bookkeeping, is really the same. Like I'll echo that sentiment here. When you have accurate financials, you can, when your books are up to date and accurate, then you can run financial statements. Right? Whether P&L is a profit and loss statement, also known as an income statement, right? And then balance sheet, cash flow statement, or these are financial statements. And if your books are updated and accurate, then you can always run your financial statements at the snap of a finger and always know your numbers, revenue, cost, profitability. You're always keeping your finger on the pulse, and you can make business decisions based off of what the numbers are telling you. Building projections right now. So projections, I always, I'm a big fan of every business owner building their own projections. Like, think of it like you're in, you're in university right now, and the class project is to build your projections, right? If you're savvy with it already, then it's no problem, right? You can do projections in your sleep. But if you're not comfortable with it, like, yes, you could work with a firm like mine or another firm to build your projections. But I think that building your own projections is a great exercise as a business owner, because it really, it educates you on the, what are the different numbers, what are the terminology for this and that and stuff. You always, when you're doing your franchise, you always, with your projections, you always want to, your starting point is always item 19 of the FDD. The item 19 of the FDD is where you're going to get your revenue assumptions. And then once you have your revenue assumptions, then you can plug and play things like royalty and marketing, because those are a percentage of revenue. And then you can, do regular research to see what is fair rental value per square foot. If you're gonna the occupancy rates, the rental rates in Phoenix are going to be different than New York City, right? And then what's the going rate for labor wherever you are, right? And then you can piece together your projections just so you have an idea. So if you're doing you're going to have to do projections if you're going SBA, right? And the SBA is going to want to see the projection. They're going to want to see a correlation between the item 19 and the projections. But SBA or not, doing projections is a good exercise for you to just know, to understand, business financials, but also to get a reasonable idea of how long it's going to take for you to recover your initial investment and to, hit break even and reach, different profitability benchmarks. And so, yeah, I think that's, pretty much what I just said there covers the bullet points in the benchmarking section. So we can go to the next slide. All righty. Thank you, everyone.
Michael, great information and fantastic advice. Even if the franchisor provides you a financial workbook, you should play around with it and do your own sensitivity analysis, like the high and the low of the different revenue and expense buckets. So you kind of know the best case scenario and the worst case scenario. I'm a glass is half full kind of gal, but if I know the worst case, I'm like, oh, I could live with that, but I'll do better than I think I know that I could do it. So as Brittany stated, we feel strongly, you should work on the things that drive your business, drive the growth, and outsource things that are not the core competency of what your business, what your franchise is doing. So that does include things like accounting, payroll, any legal needs, that type of thing. So outsource what is not your core business. Often the franchisor is going to have a list of preferred vendors. So like for payroll and my franchises, they had 2 to 3 different preferred vendors that they already had vetted and had some pricing figured out. And then I just had to pick one. So that was good. Can people hear me? Robert, are you good now? Can you hear me? Okay. Eric is yes. Okay. All right. Let's go to the next slide here. So we're going to take a little quiz. You didn't think there'd be a pop quiz, darn it, but we're having one. So what are the ways that you can use the retirement funds to start your business? Or if some of you just want to shout it out, that would be fine too. All the above. Yes. All the above. And Michael touched upon all of them. I did a rollover for business startup when I funded my first franchise. And, the other thing, and I think you said this, Michael, but I'll reiterate this. If you are currently working and your 401k or retirement account is tied up with your current employer and you have no plans on leaving, obviously you cannot use that as an option. It needs to be a 401k or a TSP that is available to roll over into your new C corporation. Absolutely. I like my rollover for business startup funding simply because I wanted no debt service. And my dad was always a big one of don't do anything unless you can pay for it in cash. To be honest, a vast majority of people do want to leverage other people's money. And I think, an SBA loan is the most common and a great way to fund your business. Okay. So which entity structure is required when using the rollover? C Corp, absolutely. It's the only funding type that does dictate the entity, and that is the C Corp. And the franchisor doesn't necessarily care what kind of entity you have, but they care that you have one, to be able to protect yourself, your assets, and quite frankly, protect them. So, okay. What are the primary ways of funding your business? You'll see a theme here in the questions. Friends and family is one that we probably gloss over, but is a big one, especially if it's a small dollar amount just for like the remainder of the franchise fee. Maybe you pay it back, you work with friends and family to do that, but it's all the above. But think about if you're going to do an SBA loan, obviously you still need to pay the 10 to 30% equity injection. And how are you going to do that? Typically, it is a combination of cash, HELOC, cash, retirement funds, all the above. Okay. And then what is the main difference between a franchise fee and a royalty? All but one of you have had the initial discussions with franchisors. Some of you have already been disclosed. Absolutely, that is right. The franchise fee is the one-time payment. Typically, you pay that when you sign the franchise agreement. That is what you owe when you sign it. Often, the most common probably scenario is that you pay the franchise fee any lender, if you're doing an SBA loan, will consider that your equity injection towards the total project. So fantastic. And then the royalty payment along, typically with the national ad fund, the brand fund, all synonymous, you pay that ongoing as a part of the franchise system. Okay. So let's do a Q&A. You guys have you have a great resource here in Michael. So this is time to ask some questions. Michael, I'm going to ask one just because I think it's good to hear this, but great overview of the ROBs. But if someone was just going to take a loan from a retirement account, what does that look like typically?
Yeah, great question, Sarah. So a 401k or a TSP participant loan is on a per participant basis is limited to the lesser of $50,000 or 50% of plan assets. So if you already, I'm looking at GT's question. We'll get to that. It's a great question. If you are already in like your current employer 401k plan or TSP, you can do it there. But if you are not currently employed and you have like a old TSP or an old 401k sitting, or your pre-tax IRA, then what do? Right? Because like you can only do a 401k participant loan on a plan that you're actively involved in. And so if you're actively involved with your day job, then great. But if not, then what you do is you can set up an LLC. You can do this with the ROBs too, but usually if you go ROBs, you do the rollover. And if it's not, so if you're not going ROBs, you can, to Sarah's point in this specific question, you can set up an LLC, then you set up a 401k plan for the LLC, and then you have it custom written to have a borrowing provision in there, and then you take your old TSP, your existing TSP from a previous employer, existing 401k from a previous employer, or your pre-tax IRA, any amount of it, and you roll it over into the new LLC 401k plan. And then once it's there, you can borrow out up to 50 grand, right? So if you roll over 80, you're limited to a $40,000 loan. If you roll over 100, you're limited to 50. If you roll over 200, you're limited to 50, because it's the lesser of 50,000 or 50% of plan assets. If it's you and your spouse, then you each can do it, right? Like you can roll over 100, borrow out 50. Your spouse can roll over 100, borrow out 50.
But that's only that scenario, Michael, is if it's not associated with a current employer.
Yeah, great, exactly. Like what I just laid out there is if you were to set up your own LLC and get your own LLC 401k plan, and then you have more discretion over that compared to if it's like with your current employer. Your current employer would just be you, and it's and then how much you're able to take out would depend on the HR at your current employer in terms of like if some of it hasn't vested yet, you might be, but but what it typically is the lesser of $50,000 or 50% of plan assets.
Got it. But a lot of people you work with, if they are working, they may take a loan for it if they don't want to do a C Corp and do a full rollover.
It's a great point, Sarah. Yeah. And so, what we talk a lot about in the reader webinars is we dive into all the different things that are topics of conversation when it comes to retirement asset funding. Okay. The ROBs is the most prevalent one, but there are other topics of conversation when it comes to like what are all the different things that go into retirement asset funding. Right. ROBs, there's ROBs, right? There's also 401k and TSP participant loans, to Sarah's point. There's also, if you have a Roth IRA, any original contributions that you put into the Roth IRA, you can take that out tax and penalty free at any time, regardless of age. And then also doing a feasibility analysis between doing a ROBs. Do you do a ROBs in your situation, or do you, for example, set up as an LLC with the flow through tax nature of the LLC and take a normal distribution that's taxable and maybe subject to 10% penalty depending on your age, but you're doing, for example, like a brick and mortar. So you're going to have a big build out. And so the startup loss from the LLC is going to flow through to your personal return, and that startup business loss is going to offset the taxable distribution. And then you're only out the 10% penalty. But then you're in an LLC right? And so that's another topic of conversation when it comes to retirement asset funding. And then also there's two other little side things there's the rule of 55. So if you're not 59 and a half yet, but you're 55 and you're no longer at your most recent employer, you may be able to still take distributions that are taxable, but exempt from 10% penalty. And then there's also the 60-day rule with IRAs. For example, like what if you got to get the ball rolling on your business right now and you got to go, because if you don't, then the franchisor is going to give your territory to another investor, but you are, you have all this money in an IRA and you're selling a piece of real estate, but closing is not going to happen for 45 days from now. What do? You can take money out of your IRA, you can get the ball rolling with the franchise fee and this and that, and then when the house sells, or maybe you're waiting on an inheritance or whatever, then you can replenish the IRA within 60 days and you avoid tax on that distribution. So everything that I just mentioned, right? We talked about ROBs, we leaned into 401k participant loan, and then the other topics that I mentioned after that, these are all the topics that are discussed because the umbrella term is retirement asset funding. ROBs is the most common, but to Sarah's point, there are
There's a lot of other fish in the sea there. Yeah.
Exactly.
That was a great overview. Thank you. And a lot of people, they just need that bridge, to your point. They just may need it for like a month, and that's a great option if they need that. All right. So do you want to answer GT's question? The 100%, he has two questions in there. And then Eric has raised his hand.
Yeah, absolutely. So unfortunately, GT, accelerated depreciation only applies to fixed assets, right? So fixed assets. And so, think, machinery, equipment, furniture, fixtures, leasehold improvement, vehicles, all that type of stuff. Hard assets, accelerated depreciation of bonus and Section 179. But in intangible assets, franchise fee in this case, right? Franchise fee, goodwill, right? Intangible assets have to be amortized over 15 years for income tax purposes. Unfortunately, I tend to be the bearer of bad news when I have to tell people that, right? And then interest on an SBA loan is fully deductible. And then loan fees, there are, you have, you can write them off, you can amortize them. You have flexibility with the, you can treat loan fees different, like the write-off for them can be treated differently for book purposes and tax purposes. But for the most part, it's like they're all, the interest and the origination fees for SBA loans are all deductible, are all tax deductible. And then I've got a link that has you fill out a form. And it's probably some information that it may seem like overkill, because like if you fill out the form that Sarah and Brittany have you fill out with your assets and income and stuff, we ask for the same information, but we fill out a form with your assets, income, investment, and then once you fill out that form, then you simultaneously will get access to the webinars and the one-to-ones. And I'll defer to Sarah and Brittany, but I would just think that what we normally do at Vetrepreneur and Reader is your Vetrepreneur coach will send an email over to me, and then I'll reply, with the with the information, with the link to fill out the form. Exactly.
And I think that works well.
Absolutely. Yep.
Indeed. And I will tell you what I like about your program and the process is, some clients already have an LLC. Maybe they have investment, real estate investment, and they really just want to talk about timing or, tax strategy. And I think your process kind of hones them in on what do you want to focus on, and what decisions do you need to make first to be able to craft the right strategy.
Exactly. And like at the end of the day, we're trying to educate all of you as much as possible on these topics. Because, like the ROBS companies are great, but they're mainly focused on getting your ROBS set up, right? Like if you ask them tax questions, they're gonna, say, well, talk to your CPA. And then if you talk to your CPA, your CPA or your tax professional, may just, first of all, maybe you don't even have one, you're just TurboTaxing your taxes up until now. Or, your local CPA may just be a great tax preparer for individual taxes, but when it comes to businesses, not so much, or maybe they are with business, but they don't have, what me and my team are doing 24/7, 365 for over a decade is having entity structure and funding conversations from the angle of strategic tax planning. And so it's all attached at the hip, right? The tax implications of what your entity structure is, the tax implications of how you fund, tactical, if you're going to go LLC, here's the tactical advice for, short-term, long-term for that. If you're going to go Rob's, here's the tactical short-term, long-term advice for that, and so we're going to really get into the weeds, all in an effort to just give you as much education as possible so you can make an informed decision.
Exactly. But I know I've said this a couple times. I would say a lot of people get wrapped around the axle of setting up the LLC. It doesn't take that long, but don't do that until you figure out your funding strategy. Don't set up an LLC and then you determine down the road that you want to do a rollover for business startup that requires a C corporation. So I think job number one is getting a good handle around what is your strategy for funding, and then things will flow well from there. And, a franchisor, we'll get into this a little bit next week, but your entity typically cannot have the name of the franchise in it. So I have always been incredibly not creative and use like a combination of my initials or, Brown or something in there, SEB Services LLC or C Corp, and then you get a doing business as or a fictitious name of Glass Doctor of St. Paul, Minnesota. So the franchisor, your entity can't contain typically any of their marks or their name. You get a fictitious name of the franchise. So that is typically how that naming convention will work. Some franchisors want to be involved in the naming of your entity, or at least want to make sure that they know it. And some don't care because typically it's not consumer facing. You may have it on invoices and things of that nature, but you're going to use your DBA for advertising and other things that are more consumer facing. Okay. All right.
Erin,
Brittany, did you
still have
always use your initials, or were you more creative than I was?
No, not that creative. We use my middle name and my husband's middle name, LLC. So
Nice.
yeah.
Very good. And so guys, we're going to stay in one group today because we do have Michael, and three of my folks are either with franchisors and one is out of the country. So we'll just stay together. So what other questions do we have? Otherwise, Brittany and I could ask a few.
I got a quick question. Actually, it's maybe could you go into depth on the using an IRA as a bridge loan, the 60-day rule?
Yeah, so pretty much you can take a distribution out of your pre-tax IRA. You can use the proceeds for whatever, and as long as you replenish the IRA with that amount, then that distribution will be tax-free.
And that goes for traditional or Roth?
It goes for traditional.
Traditional, okay.
Roth, you said you could only pull out your original contribution, correct?
Right. So for Roth, your original contributions you can take out at any time, tax and penalty free. And so if you have and it has to be a Roth IRA. So if you have a Roth IRA, let's say you have a Roth IRA, $100,000 Roth IRA, $60,000 of original contributions and $40,000 of earnings, you can take the $60,000 out tax and penalty free at any time. If you have Roth assets sitting in a 401k, like an old employer 401k, and you made the salary deferral out of your paycheck, going towards Roth, that's original contribution. But you can't take that if it's in order to take that original contribution out, you have to first roll it over to a Roth IRA. And then once you roll it over to a Roth IRA, then you can take the original contributions out, like the original contributions that you made through salary deferrals, through your payroll deductions. You can't take it out of your Roth 401k. You have to first roll it over to the Roth IRA and then take the original contributions out. And then is that help? Before I go to Sarah's question, is that good, GT, or any follow-up?
Yeah, and the point people for that would be the custodians or administrators for the IRA, not necessarily a specialized firm or something like that.
Great question. Yeah. So the custodian, exactly. Like the custodian, if the 60-day rule passes, or then it'll trigger the 1099-R, which is the form for the distribution. And then also we have a few of these right now where it's still like if you take it out in like mid December and then you don't replenish it until sometime in like February of the next year, that still may trigger the form, and because the year cut off, and then we'll just have to make a manual adjustment in the tax software and provide a disclosure and stuff with because it still qualifies. It just kind of went into the new year. So as long as you keep the custodian in the loop, and obviously your CPA, it should be a non-issue. But if a 1099-R gets generated because it crosses over to the new year, for example, that doesn't mean that it's taxable. It just means that you just have to do some manual data entry, some manual overrides on the software. And then if the IRS ever questioned it later on, you would have the full documentation to support that you put it back within 60 days.
Okay, thank you.
Of course. And then Sarah asks, so it's a great question, Sarah. No, the lesser of $50,000 or 50% of plan assets only applies to 401k participant loans. If you've got $300,000 in a pre-tax IRA and you wanted to take 300 of it out for whatever reason, and you put 300 back in 60 days, then you're good. You're in the clear, and
I thought
no
so.
tax.
Okay. Yeah. I just wanted to make sure. So it's the
Mhm.
60 days that is the critical piece.
Exactly.
Yeah. But you could do half or you could do the whole thing.
Exactly.
Okay. Perfect. And I think for a lot of people, if they're waiting on an SBA loan to close, that can be a good option, and they just pay themselves back and put it back in.
Exactly. You got it. Yep.
Yeah. Okay. And at that point, if that allows you to have an LLC, and not a C corp with a rollover for business startup, that may be an overall better tax strategy.
Exactly. And it gets back to, what do you put on your three buckets, right? What's your investment? What are your assets? And what's your income? Because It's all attached at the hip. What GT puts on his form is different than what Robert puts on his, is different than Eric, is different than Jonathan. And so, like we may take a look at Jonathan's form, we may take a look at Jonathan's three buckets and be like, hey, Jonathan, we think that you should go Rob C Corp, and here's why, right? And then you're going to have the why behind it. Like, hey, Robert, we think that you should go LLC with a leverage strategy, whether it's SBA or HELOC or a margin loan or a 401k participant loan. And here's the short-term and long-term reasons why, right? And so, because maybe it makes because if the investment is going to be brick and mortar, and you've got minimal equity in the house, minimal cash in the bank, and you've got retirement assets, Rob's might make sense. But also in that situation, just taking a normal distribute and forget about the 60-day rule. Maybe just take the one-time hit of the 10% penalty, because the startup loss is going to offset the taxable. So it's not going to be subject to regular tax. It's just because the LLC structure, the loss is going to flow through to the personal return. It's going to offset the 1099, the taxable distribution. So you just, the one-time hit of 10%, maybe that's what you do, right? So it all, what is the customized entity structure and funding strategy for you? It all depends on what you put on your three, it all depends on what's in your three buckets. There is no painting everything with one broad brushstroke. We start what's the input? The input is your three buckets, and then the output is the optimal entity structure and funding advisory.
No, so well said. And I did have a question from Sachiko that could not be on the call today. And one of her questions was that, if accounting and that kind of thing is new to her, would your firm or someone who will look at some of her pro forma assumptions, for an SBA business plan? My advice was, hey, you should go through the exercise yourself. Absolutely you should. And I said, hey, Michael Reeder and the Reeder Group, will they do that as part of their services? Sure. But doing that exercise on her own, she should do that regardless. Some franchisors will weigh in, but some feel like it's an end run around the earnings claim rule, and they won't necessarily do it. Now what they may tell you is, hey, Brittany, your assumption on these buckets is a little high. You may want to do a few more validation calls. But Michael, I'm assuming your group, you do that periodically if someone wants a sanity check on what they're doing.
Yeah, absolutely, Sarah. So a couple things. One, when you get connected to us, when Brittany or Sarah introduces you to us and you get access to the webinars and the one-to-one consultations, all that's for free, right? And so if you want to dedicate your free one-to-one consultation to like do a high level overview of your pro forma, we can allocate time to that, right? And you're not going to get charged for it. If you wanted us to do it for you, then that is a billable service that we offer at our firm. But then also the lender that you're working with, right? Like your lender, they've got a front of house and a back of house, right? The front of house is your loan officer and the back of house are the underwriters. And so, there are some great loan officers out there that will, unlike, to Sarah's point, franchisors have to be careful because of earning claims, but the front of house loan officer, there are some that, really, really know their stuff. And there are some that, maybe are not so well versed, but like for the ones that have, that are really well versed in pro formas and they could, help you kind of tweak, I got your projections. Hey, Jonathan, I got your projections. Before I submit it to underwriting, let's clean this up and let's clean that up first. And then they'll throw it back at you. So that, there are some proactive loan officers out there that will on the front of house that'll help you make some tweaks before it gets submitted to underwriting. Ultimately, what SBA is looking for on pro formas is can they look at your pro forma and look at the item 19 of the FDD and see a correlation?
See a through line. Yeah, exactly. Absolutely. And the other thing is, this is just Sarah Brown's opinion, but all things being equal, if you go and get, Fram Fund or another funding partner and you, talk about an SBA loan, using the preferred lender potentially of the franchisor can be helpful because that lender probably has an experience with that franchise and they probably are very well versed and can say, wow, GT is pretty low. Wow, you might want to do this, or, they may even provide, it may be a more streamlined process. Do you have to use them? Of course not. But all things being equal, sometimes they'll give you slightly better terms. Like maybe it'll be less money down, as your equity injection or things of that nature.
Right, exactly. I will say before we go into Jonathan's question, I do have a hard stop at the top of the hour because I try to have 15-minute buffers, but I do have something at 2 p.m. Eastern. But Jonathan says
answer what you can of his, and then Brittany and I will do our best.
Got it. Let's see here. Let's see.
Mostly around the BR&E self-employment source.
Michael, if you're not familiar with that, I could probably speak on that if you need to head out.
Okay. Yeah. If you don't mind, Brittany.
Yeah.
Michael, thank you so much.
Yeah,
that was fantastic.
My pleasure, Sarah and Brittany and everyone. It's great to be with you. Take care.
Thank you,
Michael.
Brittany, I'm going to let you address that because I'm not as well versed probably as you are.
So VR&E, if you guys are familiar, right? If you have, I think it's 30% or above disability, then you can qualify for VR&E. Obviously, you have to meet with a VR&E counselor and kind of plead your case as to why you deserve this funding. Jonathan, I will say that from my own research and speaking with other veterans, the self-employment track is the hardest one to get funding for. They are very reluctant to give money to start any sort of business because it's a gamble, right? So they're much more willing to give you money to put into an education, a different degree, but not necessarily self-employment. So you really have to have a good case for it. I know. I saw Eric nodding too. It's very difficult, but not impossible.
Do you think that franchising is considered a little less risky than starting up, Jonathan's widget factory?
Yeah, I guess it could be, but it also just depends on the counselor you're going to get, right? And especially with all of the veteran disability news that came out over the past couple of days, and then possibly, you know, taking away disability paychecks to veterans, it could be a tough sell for VRNE. So I definitely wouldn't rely on, you know, the VRNE self-employment track to fund your business. But, you know, could be a good effort on the side to try to get some of that, that financial help. Awesome. All right, you guys. Well, any other questions? Okay, so I think our next meeting is going to be, is that next Thursday, same time?
It is, with Michael Rosenthal.
Perfect. All right. Yeah, that's going to be another good one. We've had 2 back-to-back awesome group sessions with lots of information. So yeah, next week we'll be going over FDD reviews and validations. So bring your questions to that. Otherwise, Sarah and I will see all of you guys on our next one-to-ones. Thank you all for being here. Thank you, Sherry, for running the slides.
And if you want an intro to Michael and the reader group, let Brittany or I know, and we'll make that happen, just like an intro to a franchisor.
Yep, absolutely.
Thanks,
All right, you
Brittany.
guys.
Thanks,
Have
Sherry.
a great weekend. Bye-bye.
Bye, everyone.